Welcome to More Living with Jim Brogan, your source of information for living the best years of your life, your way. For more than a decade, host Jim Brogan and his expert guests have come together each week to share important news and advice that can impact the lives and well-being of those who are retired and those nearing retirement. Learn about issues like health and fitness, financial planning, Social Security benefits, investment advice, and more. And now, here's the host of More Living, Jim Brogan.
Good morning, East Tennessee, and welcome to More Living with Jim Brogan, where it's all about living the best years of your life your way. This is News Talk 98.7 WOKI, and I want to ask you a question. What is the number one expense you will ever have in your lifetime? What do you think it is? I know as you're sitting in your car this morning or at your home, you're probably thinking, well, my house. Maybe you're thinking your health care. Neither of those pale in comparison with the number one expense you and I will ever have, and that expense is taxes. All the different taxes that we pay. So, minimizing our income tax burden is one way we can really bolster the return on our monies and create more wealth. It's overwhelming the impact that can be made there. You know, when we talk about financial planning, everybody thinks about, usually how do we invest our money? But there are a lot of different ways a financial plan can improve your outcome. And tax planning is maybe as big as there is. In addition to the investing side. Now, income planning, all of it's important, but income tax planning is just huge. And, tax planning is not what we typically do with our CPA every year here this time of year. We're kind of getting into that season, right? Here shortly. You're starting to get all your 1099s and you get with your CPA. That's tax preparation. Tax preparation is looking in the rearview mirror. Things have already happened. You've already had things that have generated your 1099, you cannot undo it. So there's a limit to how effective tax preparation is at minimizing your income taxes. All you're doing at that point is using whatever the Internal Revenue Code allows. But you've already triggered all those events. Tax planning, by contrast, is looking forward to the future, and it's making intentional decisions that can impact your tax return. So, for example, how much have you saved in your IRA or 401k? Imagine for a moment that when you withdraw this money in retirement, you could have 30 or 40 or even 50% less than what you have now. And that's the impact taxes can have on your retirement. That's just the same thing could happen to the money you're counting on from Social Security, your investment income, what you do on your income and how you make decisions that potentially impact your tax return affects the amount you potentially pay in tax on your Social Security income. It also affects potentially how much Medicare premium that you pay. So most people overlook the significant impact it could have on their nest egg. They think they don't have a choice in the matter, but I'm here to tell you that in most cases they're wrong. You have a big impact potentially on your income taxes, and you'll have typically more control over your income taxes in retirement than any other time in your life. You have more control over how much you pay in taxes than you may know. So on today's show, I'm going to talk about 3 retirement tax time bombs, and I'm also going to cover 10 simple tips to reduce your income taxes. So first we're going to hit the 3 time bombs, then we're going to talk about 10 tips to reduce your income taxes that you may not have thought about. So let's dive in. Retirement tax trap number 1 is how you withdraw money from your IRA or 401k. How do you contribute money to your retirement account? How do you draw money out of your retirement account? So when we talk about IRA or 401k, I kind of use those words synonymously. Certainly they're technically can be different rules, but the taxation of them works roughly the same. But when I say that, I really mean any type of a tax of a retirement account where you or your employer set money aside, and then as that money is growing, you're not being taxed on it. So it may have been deducted from your paycheck, or you may have made an IRA contribution, but I'm talking about all of those different qualified retirement types of plans. So it's an IRA, it's a 401k, it's a 403b or tax sheltered annuity, it's a 457, a 401a, a Keogh savings plan. Those are kind of old. You might still have that. I don't see that a lot. But then there's a SEP IRA, which is really just kind of a type of an IRA. And then there's a whole alphabet soup. There's actually between 20 and 25 different types. All of them except for Roth. Roth has a different tax treatment, but all of them except for Roth, the tax treatment is pretty much the same. There are a few odds and ends on the rules in terms of when you can take money out and when you have to take money out, depending on if you're working. I won't get into all that today, but in terms of how they're taxed, everything except a Roth, the way I want you to think of this is, I've got a balloon here, and I'm going to blow air into that balloon. When I blow air into that balloon, that's you or your employer making contributions to your retirement account. Most of that money, if not all of it, when it goes into the balloon, it was not taxed before it went into the balloon. In other words, it was deducted from your taxable income if it was deducted from your paycheck, or if it was a deductible IRA, you did it on the bottom of page 1 of your tax return. So most, if not all of it going in was not taxed. You might have had some that was, like after-tax contributions, especially to 401ks prior to 1987. You might have had some of that. It would probably be a low balance compared to the overall size of the account. Now then, think of that balloon. Once you make those contributions, that balloon grows while you're working. Are you taxed on that money as it grows inside that balloon? No, you're not. You don't get a 1099 on your 401k while you're working. The only way you get a 1099 is if you take a distribution. So it's growing. There's no tax implication as it grows. It's one of the real powers of saving money in a retirement account. It's not got what we call tax drag, tax that's constantly dragging on the money. So you haven't paid tax on the money that most, if not all, that was contributed. You hadn't paid tax on any of the growth. So what do you think you have to do when you take money out? You got to pay the income tax. So you really should look at your retirement account like it's a partnership with you and Uncle Sam. You do not own all of that money. The IRS is going to get a chunk, and eventually you have to pay the IRS. These are great places to accumulate money because you're getting that triple compound interest that Albert Einstein called the eighth wonder of the world, or the greatest concept of mankind. That triple compound interest, where you're getting interest on the principal, you're getting interest on the interest as it compounds, and then you're also getting interest on Uncle Sam's share. You don't have that tax effect every year, so you can just let it sit and grow. So they're great places to accumulate. They become problematic when you take money out. These are pre-tax dollars. You have to pay tax on every single dollar you pull out, on most of it, if not all of it. Then when you're 70 and a half, you have to start taking money out, because that's when the required minimum distributions happen. And the reason the IRS requires you to start doing that is because the IRS wants to start getting paid their share. So you have to take some money out, and then it triggers a taxable distribution. You get a 1099. It's ordinary income. If you don't follow the rules to a T, you could face penalties of 50% of the distribution you should have taken, but you did not. Minimum distributions could throw you into a higher tax bracket. There's nothing you can do about it once you're there. There are some great things you can do about it when you're in your 60s. So when people retire, and you're in your 60s, you no longer have earned income, maybe you have large retirement accounts, and you know at 70 and a half the dynamic is going to change, because then you're going to have to take your minimum distributions. And just to use a rough number in your head, figure 4% is what you'll have to take out. It's a little less than 4% the first 2 or 3 years, but just think about that in your head. So if you have $1 million in retirement accounts between you and your spouse, if you're married, that's a $40,000 taxable distribution on top of everything else you have. You don't have that in your 60s. So you have some real opportunities here to keep your tax bracket really low in the 60s. But, if you know your taxes are going to be much higher when you're in your 70s, maybe you should take advantage of going ahead and triggering some taxes when you're in your 60s. If I can look at it this way, if in my 60s I can control where I draw my income from, and a lot of it be tax-free, and I'm in a 12% tax bracket. And I know that once I'm 70.5 under current tax code, I'll be at 22% bracket. But really in 2025, the tax rules go back to what they were in 2017. So 22 becomes 25. So think about that. I can maybe take money out now at 12% versus take money out later at 25%. Well, which is a better deal? And that's what Roth conversion planning can do for you. Now, there are a lot of other opportunities. That's just one, and I'm going to get into many more today. But I'm going to hit the biggest ones. But having a comprehensive plan, a tax plan for dealing with your distributions from your retirement accounts. And you must take action ahead of time because you lose a lot of the control of the taxes, at least on the retirement accounts, once you're 70.5. Now, you still, if you're listening today and you're over 70.5, you still may have a lot of opportunity. But you do lose some control when you turn 70.5. And then as a side note, another problem you have is once you're 70.5, you are forced to take that money out. And so what happens when you're in bear markets? And you have to sell off investments and take distributions to satisfy IRS. You know, you should have an income plan to deal with that. So you don't have to be selling investments when they're down. You know, it's always okay to sell investments when they're down and reinvest, but you don't want to have to sell them and spend them when they're down. And your minimum distributions are going to trigger mandatory distributions. But with a good plan, not only for taxes, but also income, you can structure your investments so when markets are down substantially, you don't have to sell market investments. You can draw elsewhere from safe monies. So all of this is just critically important. But minimum distributions from your retirement accounts could pose a major threat in up markets and in bear markets. You've got tax risk, you've got sequence, selling in down markets, compounding losses. All of this stuff becomes critically important. The bottom line is you have to have a well thought out plan of when you're going to withdraw money from your retirement accounts and how you're going to plan for that while before you're 70.5 and then also after you're 70.5. So have you ever wondered how some people get away with paying far less in taxes? Warren Buffett and Mitt Romney back in 2012 was discovered they had an effective tax rate of about 17%. They were paying less effective income taxes than most upper middle income Americans. That's because of tax planning. So how can you apply tax strategies? You don't have to have billions of dollars in order to do that. So we can offer you a tax reduction analysis, how you can save potentially thousands of dollars in taxes on your retirement account distributions, overlooked opportunities with the Trump tax plan, the Tax Cuts and Jobs Act, plus how you could minimize or avoid, reducing taxes on Social Security benefits and not trigger additional tax on Medicare premiums. So if, most advisors would charge hundreds or even thousands of dollars for that type of an analysis. Most advisors don't really do tax planning, but those that do would usually charge a pretty heavy fee. We'll give you a free analysis if you're one of our first 10 callers. You can call us at 865-862-6800. If you're in your car, go ahead and leave us a message. We'll call you Monday. Again, that's 862-6800. When we come back, are you prepared for what could be a huge tax bill on your Social Security benefits? So coming up next, the strategies that could help you minimize taxes potentially on your Social Security benefits as you listen to More Living with Jim Brogan, only on Knoxville's News and Talk of East Tennessee, News Talk 98.7 WOKI.
You are listening to More Living with Jim Brogan. During the week, Jim is a financial advisor, an author and speaker with an MBA from the University of Tennessee, who specializes in helping people in or near retirement plan for the next phase of their lives. You can reach Brogan Financial during the week at 865-862-6800 or on the web at broganfinancial.com. And now, here's Senior Market Advisor Magazine's 2011 National Advisor of the Year and host of More Living, Jim Brogan.
What are you doing to reduce your tax bill? How are you planning looking forward so you can truly be effective? Did you know that you could pay tax on as much as 85% of your Social Security benefits? So how the money you were counting on to help pay for your retirement could be a fraction of what you thought it was going to be. I'm Jim Brogan. You're listening to More Living right here on News Talk 98.7 WOKI. And I'm talking about 3 retirement tax time bombs And a little bit later, I'm going to have 10 specific tax tips to save you on your income taxes. It's the largest expense most of you and I will ever have in our lifetimes, and it's not even close. One of the greatest impacts you can have with a well-developed, comprehensive financial plan is to reduce your income taxes in the future and be smart about how and when you pay taxes. And you have more control over taxation in retirement. Most people do, not everybody, but most have more control in retirement than any time in their lives. In this segment, how can you minimize taxes on your Social Security benefits? You know, when Franklin D. Roosevelt passed Social Security in 1935, he said, as long as I am alive, you will never be taxed on your Social Security benefits. Well, that was a long time ago, and of course he died. And then we had a whole bunch of other presidents. In the 1980s, the Reagan administration signed a bill into law. It was passed by Democratic Congress. It was signed by President Reagan that created potential income tax on your Social Security benefits, where up to half of your Social Security income would be subject to income tax. Now, that is not a 50% tax. It means 50% of the income is subject to ordinary income tax and gets added in with everything else. So if you have $30,000 of Social Security income on your tax return, then up to $15,000 of it goes over onto the right-hand column of the 1040. So on the A box, it says $30,000. That's the total benefit. And then on the B box, which is the right-hand side of the 1040 that gets added in for income, it'd say $15,000. Then in the 1990s, Bill Clinton signed a bill into law that added a new threshold up above. If you make more money, up to 85% of your Social Security is subject to income tax. So a Republican president signed it in the 80s. A Democratic president signed it in the 90s. We're not going to get into a political discussion on that right now. That's not the topic of today's show. But it's a big impact. Now, think about this. In the 80s, when that was first passed, it was before 85. It was the early part of the decade. And the income numbers that are used to determine the threshold for determining how much of your Social Security is taxed have not changed in 35 years, over 35 years. The numbers from the early 90s have not changed in over 25 years. So think about that. I mean, in the 80s, early 80s, there weren't a lot of retirees, nearly the numbers of retirees earning enough to trigger this additional taxation in what there are now. It's a big problem. Retirees today are getting a hidden tax increase every single year with this topic. In taxes on Social Security income. It is not adjusted to cost of living. So every year, more and more people pay more and more tax on their Social Security benefits. You never hear about that in Congress. But it's a hidden tax increase on retirees today. What we want to do is we want to see how we can maybe control or reduce the impact of that. And I don't want to get too into the weeds on this because, in terms of really explaining how they crunch these numbers, but here's it in a nutshell. Anything at all that's going to show up on page 1 of your income tax return potentially impacts taxation on Social Security benefits. All taxable income on page 1 counts. Half of the Social Security income number counts. So if you have $30,000 in Social Security income, $15,000 is going to count against they call it provisional income, but it's going to count against you. And then, believe it or not, your tax-free municipal bond income counts. You may have wondered, why in the world do I have to report my tax-free municipal bond income on box A on my tax return? It's not taxed federally. Well, it potentially impacts taxes on Social Security benefits. It's treated as any other kind of income. And guess what? It's also triggers a potential Medicare premium. Tax-free municipal bond income is considered the same as any other kind of income when it determines your Medicare premium. When you hear it's based on modified adjusted gross income, that modified is they add in the tax-free municipal bond income. Same thing on the provisional income for Social Security taxation. So it's understanding these potential opportunities, you know, and again, I'll go back to when you're in your 60s and you have and you're retired. You don't have to take minimum distributions from your IRAs and 401ks and other retirement accounts yet. You're not 70 and a half. You have the opportunity potentially to maybe stay in a really low tax environment, which could keep your taxes on Social Security income down. If you start doing some planning for that, which I recommend, especially with the IRAs and 401ks like I talked about in the last segment, when you do that, though, you do potentially drive up some of these other issues with Social Security and Medicare premium. So it's all very interrelated. So it just takes careful planning. And most people that I talk to have not done any of that type of analysis on how this is interrelated. It doesn't, you know, it is complicated, but, you know, that's what, you know, that's the job of somebody like me and our firm and other planners that truly do this type of planning, is to analyze it and show you where the opportunities are in plain English, in your language, so you can understand it and implement it. But this is a huge issue. Most people just are not aware of all the interrelatedness. You know, I wasn't even going to get in on this, but today, but you know, one big problem a lot of people have is they're working, they're making a lot more income than when they're going to be retired. They retire. Now their income's way lower. It drops substantially, yet they get penalized on their Medicare premium because their income for Medicare premium, they're looking at 2 years ago. The amount of money you pay for Medicare in 2019 is based on your income in 2017. So what if you were working in 2017 and you retired the first of this year? You're penalized for 2017. Well, guess what? You can do something about that. You can actually get that lowered based on your expected income in 2019. Then you'll have to do it again in 2020. Most people don't even know that. In some cases, that could be as much as $8,000 to $10,000 a year for a married couple in Medicare premium savings over per year for 2 years. You're talking about $15,000 to $20,000 for some taxpayers just on their Medicare premium. So understanding the relationships of all of these things and then having a plan to deal with it is so critically important. I just cannot underscore it. It just can't emphasize it enough. So I want to tell you about we talk about these issues in great length in my college classes, my adult education. My next one is at Pellissippi State Hardin Valley on March 5th and 12th. I'm also in Blount County on March 26th and April the 2nd. So I would love to see you at these classes. So we're out in West Knoxville in early March 5th and 12th. We're in Blount County, out kind of towards Friendsville there at the beautiful Pellissippi campus, March 26th and April the 2nd for you folks out in Maryville, Blount County, or even if you're off that North Shore area, you can get out there in about 15 minutes. If you're close to North Shore and Pellissippi, if you can't make the one in Hardin Valley. If you go to PellissippiRetirementPlanning.com, you can find out more information. We have 7 main topics that I teach in that class for Pellissippi. And you can find out more information. They do offer a couple's discount. It's $59. For a couple, it's $89. So go to PellissippiRetirementPlanning.com. It gives you both of the classes. And then you can click to register, shows class topics, has information about me as the instructor. But this is one of we spend a good bit of time. I spend probably an hour and 15, it's 2 2-hour sessions. I spend probably an hour and 15 minutes just on tax planning because that's how important it is. And I say an hour 15, then in other parts of the class, I'm always hitting on different tax impacts and opportunities. So I would love to see you there. Go to PellissippiRetirementPlanning.com. When we come back, you've heard of investment diversification, but what is tax diversification? So coming up next, why it's critical that you don't have all your eggs in one tax basket. Don't go away. This is More Living on News Talk 98.7 WOKI.
Through his weekly radio show, television news appearances, and adult education classes taught at the University of Tennessee and Pellissippi State Community College, Jim taps into his extensive knowledge and experience to address issues important to living your best retirement. Join Jim every Saturday morning at 9 a.m. here on News Talk 98.7 WOKI, and visit him online at BroganFinancial.com. And now, here's the host of More Living, Jim Brogan.
Welcome back to More Living with Jim Brogan, where it's all about living the best years of your life your way. This is News Talk 98.7 WOKI. We're talking about the number one expense most of you and I will ever have in our lifetimes, and that's your tax bill. If you hate paying taxes, wait till you retire. Is your tax bill going to drop as much as you think? And even if it is going to drop, maybe it could drop even more with effective planning. You could be paying far more tax than you ever imagined. Taxes on your IRA and your 401k and other retirement account. Taxes on your Social Security income. Taxes on investment income. It could be a field day unless you take actions to protect your taxes. So today we're talking about 3 tax time bombs. And then in my final segment, I want to talk 10 specific tax tips that you can implement potentially that could help save you on your taxes that are very, very overlooked. And by the way, I have a bonus tip for self-employed individuals that most CPAs are not aware of. So retirement tax planning tip number 3, tax time bomb number 3, tax diversification, not having tax diversification. Now, this is particularly relevant for you younger folks. Particularly relevant. But here's the bottom line. Where are our taxes now, and where might our taxes be in the future? Well, actually, under the current tax code, we absolutely know that our income tax rates are going to go up in 2025. So we have, 7 years here, 2019 through 2024, to really make hay. I guess that's 6 years to really make hay. Because in 2025, we go back to the old rules from 2017. And for most tax filers, that means a tax increase. Unless Congress makes it permanent. To make it permanent, they're probably going to need 60 votes in the House. Call me a skeptic. I'm sure most of you agree that ain't going to happen. It could. You never know. Congress could change between now and 2025 substantially enough to make that happen. But it ain't going to happen in the next 2 years. I'll just tell you that right now. They're not going to get 60 votes. So we know, number one, we're going to have a tax increase in 2025. And if you're retired, or when you retire, and you're in your 60s before you're 70 and a half, then you'll also have a tax increase based on those minimum distributions. So we have opportunities when we're in our 60s to manage that somewhat. Then we have, it becomes even more complicated when we look at our overall budget situation in the United States. I don't want to go too far down this road, but let's be honest. Who thinks that we have a fiscally sound situation here in the United States? I mean, we're talking $21 trillion in national debt. Social Security and Medicare are on shaky ground. Medicare is really the big elephant in the room. Social Security's probably not a difficult problem to solve if they'll just solve it. But those solves will probably affect people under age 55 and certainly younger folks. According to Forbes magazine, your taxes could double in the coming years. Double. Because of the problems with our unfunded liabilities for Medicare and Social Security and prescription drugs on top of our debt. The estimate was that federal debt, according to the Washington Times, in the next 30 years could reach $100 trillion. So where do you think taxes are going to go? Now, I mentioned 2 tax increases that we know you're going to have. 2025, we're going back to the 2017 rates. We know that's going to happen, barring an act of Congress, literally. And then if you're in your 60s and you're retired, you've got your minimum distributions at 70.5. You know your tax rate's going to go, your taxable income will go up at that point. So tax diversification, look at it this way. If you have all of your money saved in your 401k or IRA, all of it's tax coming out. Either most of it or all of it is taxed coming out. So yeah, they're great places to accumulate money. They become very problematic when you take money out. Now, money in a Roth is not tax coming out. But now let's be careful here. Roth IRAs and Roth 401ks, I want to be clear, they are wonderful things. However, they are flat out oversold in this country. When does a Roth 401k or Roth IRA beat a traditional IRA or 401k? On a traditional, you get a tax deduction up front. So if you want to save $10,000, it doesn't cost you $10,000. If you're in a 20%, if there isn't a 20% tax bracket, but just use round math. Let's say your tax bracket, I'll use an actual bracket. Let's say it's 33%. You're going to save $3,300 on your income tax return. You can actually put in, if you can save $10,000, you can actually save closer to $14,000 for a cost of $10,000. Whereas if you're putting it in a Roth, you can only put in the 10 because you're getting a tax deduction up front. So you can put more money into a traditional IRA or 401k than you can a Roth for the same amount of money. But then the Roth is tax-free coming out. So you get the tax benefit up front with traditional IRA or 401k. You get the tax benefit coming out on a Roth. The only way that works in the end is if your tax rate when you're pulling money out is higher than when your tax rate is going in. And when you retire, do you typically have more taxable income or less taxable income? Most people have less taxable income and certainly much, much greater control of their taxable income. Now, once you're 70.5, that may change, but most people still see their taxable income drop, in which case the Roth doesn't make any sense. But that's if we know where tax rates are going. So the Roth can be a powerful tool to manage taxes, especially when you're in your 60s and already retired and your tax rate is low. That's when you can do some Roth conversion planning where you pay tax maybe at 12% today instead of 25% after 2025 when you're 70.5. I mean, and with today's tax rates, I mean, you may be over 70.5 and have a large retirement account distributions. I mean, you could be $250,000 in taxable income or $280,000 or $300,000, and you could go ahead. You could pay tax now at 24% instead of tax tomorrow in 2025 at 33%. Well, 24% is a lot better than 33%. So that's when Roths work. Now, for you younger folks, you've got. What's the likelihood tax rates are going to be higher in retirement for you when we look at our government situation? So here's what tax diversification is. It's saying, we don't know where tax rates are going to be in the future. We don't know if they're going to be, I'm pretty confident they're going to be higher. We don't know how much higher. For you younger folks, we don't know how much taxable income you're going to have in retirement. That's a long time down the road. But so tax-free income in retirement is great, but we also, if we're in a high tax bracket today, we want to get some tax deductions now when our taxes might be higher than they are in retirement. So tax diversification is kind of saying, I'm not going to have all of my investments in one location, a traditional 401k, or all in a Roth, or all in non-retirement accounts. I'm going to have my money spread around. Because we have this uncertain tax future. And so tax diversification is saying, I'm going to build up both of these pots as it makes sense so that where I get some tax benefits now on traditional 401k and IRA, but then I also get some tax benefits down the road with Roth distributions. So I'm kind of doing both. Tax diversification, especially for high income earners, tax diversification makes a whole lot of sense. For you younger folks that are that are still, just starting out, don't have high taxable income, Roth is a no-brainer to me. But as you earn more and more, it becomes less of a no-brainer where you want to get some tax benefits now, especially if you're up in 33% tax brackets. So be wise and efficient with our tax diversification, because there are some real opportunities there to get some tax benefits now and also get some tax benefits down the road. So I do want to mention, in our last segment, I'm going to cover 10 quick tips that you can take advantage of, that many of which are very, very overlooked. And I'm going to have one bonus tip that's huge. Bonus tip. I do want to let you know, I published last year a guide to the Tax Cuts and Jobs Act. And one of my tips in particular, I'm going to talk about the Tax Cuts and Jobs Act in the next segment. You won't want to miss that. But I'd love for you to get a copy of my free guide on the Tax Cuts and Jobs Act. You can actually get that. And if you go to broganfinancial.com and click, and if you'll just scroll down on the main page, just scroll down, and there towards the bottom, there's a review of the Tax Cuts and Jobs Act. You can download that guide. I'd love for you to download that, because it's just a quick overview. And many of the things in there, even though it's a quick overview, are things that have not been covered really hardly at all by the media, and a lot of people are just unaware of. So in the next segment, I'm going to talk about a couple of tips to take advantage of some of the things in the Tax Cuts and Jobs Act. But if you'd like to get a free copy of my review of the Tax Cuts and Jobs Act, go to broganfinancial.com, scroll down to the bottom of that page, click on, there's a review of the Tax Cuts and Jobs Act. You can click to download that guide, and I'd love for you to have that. When we come back, 10 specific tax tips that many of you can apply to make an impact on your taxes, including a bonus tip that most people overlook and aren't even aware of. So don't go away. This is More Living with Jim Brogan, only on News Talk 98.7 WOKI.
Thank you for listening to More Living with Jim Brogan. If you miss any of today's show or want to listen to it again, visit broganfinancial.com, where you can access the podcast and other educational materials to help you in your journey through retirement. And now, here's Senior Market Advisor Magazine's 2011 National Advisor of the Year and host of More Living, Jim Brogan.
Welcome back to More Living here on News Talk 98.7 WOKI. I am Jim Brogan, your host. Today we are talking about the number one expense most of us will ever have in our lifetimes, and it's our taxes. All of the different taxes we pay. In retirement, you have potentially, most people have more control over their taxes than any other time in their lives. How are you going to reduce your tax bill? We've discussed 3 tax time bombs in retirement. Now we're going to talk about 10 little-known tips. Many of these you can use. Most of these, you probably not really heard much depth. You might have heard about it, but not much depth of how to really attractively implement planning. So we're going to talk about that. Real quickly, I do just want to reiterate, I've got my upcoming classes. I'll be in Hardin Valley at Pellissippi State, March the 5th and the 12th. Taxes is a big part of what I cover in those 2 2-hour sessions, but we cover 7 main things for comprehensive planning in retirement and all the different ways you can improve your likelihood of success in retirement with your money. Again, that's March 5th and 12th. Then I'm in Blount County at the Pellissippi campus out there, that beautiful campus in Blount County. So for anybody out in Blount County or even near North Shore and Pellissippi Parkway, you can get out there in about 15 minutes. I'd love to see you out there. I believe it's March 26th and then into April, but those dates are all at PellissippiRetirementPlanning.com. You can go there and see what we're teaching, and then you can click to register. It's $59. It's $89 for a married couple out at Pellissippi's classes, and then I'm the teacher. I'll show up and teach you everything I can. Again, go to PellissippiRetirementPlanning.com. We do have upcoming class in May at the University of Tennessee. If you want to see all the classes, you can go to BroganFinancial.com and click on classes. Now, 10 little simple retirement tips that you may not be aware of, and one bonus tip that almost nobody's aware of. Tip number 1, claim all your tax deductions effectively and be mindful of the new rules in the Tax Cuts and Jobs Act. Now, the Tax Cuts and Jobs Act raises the standard deduction. $24,000 for a married couple, $12,000 for single filers. If you're 60 in the year, you're 65 and older, you get an extra $1,300 per person. So joint filers would get $26,600. So a lot of people won't be deducting anymore, itemizing. Less than 10% of Americans in estimates from the Accounting Association are expected to itemize. But with effective planning, you can itemize every other year. Planning your things like property tax payments. You can double up one year, pay none the next. Also, when you buy a car, for the tax deduction, for large purchase, if you buy a boat, any kind of large sales tax deduction, because those are state and local taxes. Now, we can't deduct more than $10,000 in that category in 1 year. But if we plan it and save up and do twice in 1 year, maybe buy our big ticket items in that same year, we potentially could itemize those years and get greater value on our tax return. Number 2, donate money to charity and goods. Your old goods, maybe you have furniture that you really can't get a good price on. If you sell it, it can be very effective tax deduction. And I talk about the power of giving. Is very powerful in a financial plan. Number 3, contribute to a retirement account. We've talked about that at length. It's the single greatest way to accumulate wealth, whether it's a traditional or a Roth. Number 4, qualified charitable distributions. If you are over 70 and a half, you can give money directly from IRA to church or charity, if it's a 501c3 on the charity, and it counts towards your minimum distribution. So it is a page 1 tax deduction. You still get your deduction on page 2, but you're getting a page 1 tax deduction on your qualified charitable distribution. Tremendous opportunity if you're over 70 and a half. Tip number 5, the 0% capital gains tax rate. If your ordinary income tax rate is 10 or 12%, your long-term capital gains tax rate is 0. And this is where, when you're in your 60s and you're not taking distributions yet from your IRAs, if you're retired, you could stay in those brackets and realize capital gains at a 0% tax rate. What an incredible, incredible opportunity to harvest gains with no income tax. Number 6, contribute to a 529 plan for your kids and grandkids. That money becomes tax-free for college and now can be used for primary and secondary education in the new Tax Cuts and Jobs Act. Number 7, offset capital gains with capital losses. That can be a very effective strategy. Equally effective, tip number 8, using capital gains to offset prior losses. Hardly anyone thinks about that. If you've had a large loss carry forward, you can use that loss to offset long-term capital gains on your investments into the future and use up those losses. Many people I meet with don't use their losses effectively. If you've got losses, let's use those to effectively make money at no income tax burden. What a tremendous opportunity. Tip number 9. Employ a tax-friendly Social Security strategy. I talked at length about that in the second segment because that's the second tax time bomb. And number 10, tax-efficient investing. How do we invest our money that's not inside of a retirement account? See, if it's inside of a retirement account, you don't have to worry about any, taxable dividends, interest, capital gain distributions from mutual funds. You don't have to worry about that stuff because it's inside that retirement account. You're not taxed unless you take a distribution. But investments that are outside the IRA or 401k, you absolutely have to worry about. Most people hold the same stuff. Now, if those holdings are relatively tax efficient, that's okay. But if you have horribly tax inefficient investments outside the IRA, doesn't make any sense. They need to be inside the IRA or 401k for most taxpayers. And our bonus tip, the backdoor Roth. What a tremendous opportunity if you are making too much money to make Roth IRA contributions. Now, the strength here is if you do not have a traditional IRA, because you can make a non-deductible IRA contribution, and that if you're over 50 is now $7,000 a year per spouse. You can do a non-deductible IRA contribution and turn around and convert it to a Roth. You're not getting the tax deduction, but you're essentially getting the money into a Roth. It's called a backdoor Roth. There's actually a couple of other versions of a backdoor Roth, but these are very effective strategies for high-income earners that cannot contribute under normal circumstances to a Roth. We can get money into a Roth in a very effective manner using advantages in the code. Thank you for tuning in this week as we've discussed your income taxes, because less taxes, greater tax planning provides for greater wealth. so you can live the best years of your life your way. Thank you so much. Thank you to Colin running the board. Thank you, Caitlin, helping produce the show. I'm Jim Brogan. This is More Living. Thank you for tuning in to News Talk 98.7 WOKI, and go Vols today. Let's get some gator bait. Have a very blessed weekend.